Hello, I'm Fenwick Huss, Dean of the Zicklin School of Business, and it's my pleasure to welcome you to our webinar today, where we explore key risks facing global banks and how they manage those risks. Joining me from the Dean's office is Gwen Webb, who will moderate the question and answer period. In our discussion today, we welcome Lisa Farkovits, Managing Director and Global Head of Model Risk Management at Barclays. Also in our conversation, we welcome Ken Abbott, who is a distinguished lecturer here in the Zicklin School of Business. And before joining Zicklin, he was America's Chief Risk Officer at Barclays as well. Leading our discussion is Larry Zicklin, former chairman of Neuberger Berman, an alum of our school, our benefactor, and I'm also proud to say an instructor in our undergraduate honors program. Larry?
Thank you very much, Fenwick, and I'm very glad to be here. This is a timely subject given what's going on in the world. Lisa, I just want to start with you. Since you're actively involved now with Barclays, I just want to make sure our audience understands that these opinions, if any, that you expressed today are yours, not that of Barclays.
Yeah, fair? That's correct.
Okay.
All views are mine and definitely don't express the views of Barclays.
Good. So I'm going to ask a question of both you and Ken. This is such a big topic. How do we define business risk? We're all searching it out. We're trying to avoid risk. What's the definition of business risk?
So I think fundamentally at the bank level, what we're trying to do from a risk perspective is we're trying to look at things that are going to impact our capital, which is the equity position of the firm. We're looking at things that are going to impact the liquidity, which is our access to cash. And then I think the last most important thing is we look at things that are going to impact the reputation of the organization, because you're only as good as your reputation. So when we're evaluating risks, those are kind of the three lenses I think most institutions look at, and they characterize the risks below the impact to those three areas. So that's my perspective.
So I would assume it depends on a magnitude of risk. How much might a certain event lower profits? When does it reach the level when it's meaningful? Who makes all those determinations?
So in a place like Barclays, what we'll do is we will look at the materiality. So we do assessments of our risk profile every year, and the person who's responsible for the risk stripe makes the assessment of is this a risk that we think is important for us to mitigate? Because there's a cost to managing and mitigating these risks. You need people to oversee them. And so those decisions will be made at Barclays. We have something called the risk control self-assessment, which is done by the businesses, evaluated by the different risk stripes, and ultimately signed off by our chief controls office and the CRO and senior people in the firm. So they're definitely looked at and assessed against the impacts of managing and the potential outcome of that risk to the firm.
I might add that you're also looking at expected versus unexpected risk. In financial services industry, you're being paid to take risk, and so there's risk that's on your balance sheet by design. Other risks, however, you want to be able to control them and make sure you can quantify things at a certain level of probability.
And so, Ken, let me go back. You've been in a couple of spots, Morgan Stanley, Barclays. Is it any different in your background than the way Lisa has described it?
No, Lisa's view is pretty consistent with the way that risk management is addressed in major financial institutions. While certainly there are differences between the way Citi and JP would approach things, at the end of the day, they're still subject to the same regulation in the United States, have the same reporting requirements, and have shareholders that can go from one bank to another in a heartbeat. So they have to maintain a certain level of consistency.
Is there any difference in the regulations as they affect a Morgan Stanley as opposed to a Citi or a Barclays?
Not really. I mean, the different firms are going to have different challenges. I think that Citi's operational challenges are pretty well documented and pretty well discussed, as are Deutsche Bank's. Barclays has a different set of challenges. Morgan Stanley has a still different set of challenges. and that's going to vary from institution to institution.
Okay, so now let me go back to you, Lisa, for a minute. How were you trained to model this kind of risk? Where did it begin for you?
So I actually didn't start with a risk background. I am a PhD dropout in physical chemistry who holds a master's degree in chemistry. And I actually started off on Wall Street on the business side. I was fortunate to get a job at Goldman Sachs straight out of school, kind of accidentally. I spent 7 years there in a variety of roles in fixed income and investment banking, then moved to Morgan Stanley running strategy for the mortgage business up until the financial crisis, when my job became liquidating the mortgage business. And I think that was my first real incident in understanding the importance of risk management and controls as a necessary tool, as opposed to something that made it difficult for me to perform my job as a business leader. And then, after that, I went into wealth management, looking at balance sheet strategy, and that's where I encountered Ken. And again, when you're looking at strategic views of balance sheet, understanding the risk in your balance sheet became very important. After taking a few years working for myself, I came to Barclays, and I was fortunate enough to have had Ken as a mentor. And he took me on to run model risk, because one of the things that I did, at least the governance side in the US, because one of the things I did at Morgan Stanley was look at the model implications of, the work we were doing in understanding the risk in our deposits there. And over time, I headed up capital here, and now I'm running model risk. So I think it's having a breadth of understanding of what could happen in a bank, and having witnessed and been involved in so many crises, and then looking at the firm and how we respond relative to those crises really gave me a good head for risk. It's not something you're born with. It's something you have to be trained to think about.
And Ken, can I ask the same question to you? How did you get involved in risk?
Well, when I started, there really wasn't a risk management group at any individual institution. I worked for a small bank in New Jersey my first year, and then I went to work for Bankers Trust. And when they set up their first risk team in 1986, I was part of that. And then from there, I went on to do some other things, including as a futures trader. But then in the early 90s, I was asked to join the risk group, covering primarily market risk, and it evolved from there. Having a trading background and being familiar with the industry, very helpful in that sense.
Well, one of the things I always tell my students is you can't plot your professional life. There's some random nature to the way your professional life works. They think they're going to go from A to B to C to D, and it doesn't happen that way, at least in my experience. And I think your experience exemplifies that.
And I think that the way that Lisa came to us at Barclays is a perfect example. Lisa hadn't done purely model-driven work, but I needed somebody to look at the model risk out there. And I thought of all the people with quantitative backgrounds that I knew, and it occurred to me that it might be a perfect fit. So I gave her the call about 7 years ago, as a matter of fact.
Almost. And I think it was like the breadth of my background, which helped me be able to understand how the various businesses use models. So again, even though I didn't have model risk, having that business understanding of the places where models could trip up the firm, I think was a value for me in that role.
Well, let's pursue that. I'm sorry, Ken, go ahead.
I also think a key attribute is that Lisa is very inquisitive, and I'll let Lisa talk about that. But it was very helpful to have someone. I didn't have to tell her what questions to ask, and she kind of went after things on her own, and I was more than happy to let her go.
Yeah, I must say, in hiring people, curiosity is a great asset in any part of the business. Lisa, how do you spend your day? What's your day like?
So no day is the same as any other day, but I wake up every morning thinking about what are the things that I don't have under control in my area of risk coverage and model risk. And what I'll typically do is go through, what are those things? Do we have a plan to fix them? And what's the impact of those different things that could crop up, so I know how to prioritize them. Because one of the things I've learned as a risk manager is you're never going to have an infinite number of resources, and you're never going to be able to throw everything at any one thing. So being able to prioritize and understanding what your biggest risks are in general and at the current moment is probably the most important thing. So right now we're in the middle of our CCAR, our capital adequacy exams in the US. And so that's taking a big chunk of my time, and it's making sure, for example, in this case, that we have adequate responses for the regulators to the extent that they're looking at our models. So that's my focus of today. Whereas another period, it could be looking at the models that we don't have adequately validated, understanding how we may want to prioritize them in the future. That could be another example of something that would come to my radar that I'd be looking at. So those are two examples of things that have taken my time, mental bandwidth recently.
And who looks at your work? You provide work to somebody. Who is that? I don't mean the name, but what department looks at it, and what kinds of reactions do you normally get to the modeling you provide?
So we don't do the modeling. We actually oversee the modeling that's done by the model owners and the developers of the firm. The people who look over our work, so there's the audit function. So there's 3 lines of defense in a bank. There's the first line, which are the people who take the risk. Then there's the risk function, who monitor the risks that they're taking. And then there's the third line, who makes sure that both lines of defense are doing what they're supposed to be doing. So the primary person who looks at what we do is an audit function. Within the second line, because we've got to have belts, suspenders, and helicopters to prevent us from doing things wrong, we assess our own controls. We then have conformance functions, which check to see how well we're complying with the frameworks that we put into place. And ultimately, I report to the chief risk officer, who makes sure that these activities are occurring the way that they're supposed to. So that way, the amount of model risk we're taking at the firm is something that the chief risk officer can be comfortable with.
So let me ask you the question. One of the worries I always had when I was managing was, we used to call it the unk, the unknown unknown. It was the thing I didn't even know was risk that was out there. And so 6 weeks ago, Russia invades Ukraine. I'm going to use the word war, which I know in Russia would get me 15 years in prison. But there's a war going on, and all kinds of things are changing right in front of my eyes. Do you get involved in that in addressing that kind of a problem?
So we would. Russia isn't an area that model risk gets involved with, but for example, the compliance department at the firm, what we do, because in this case, just as an example, there's sanctions that have been put out against oligarchs. Operational risk departments have to make sure that the operations are there to support the sanctions. You've got compliance functions that, run drills periodically to understand how they would address the sanctions and how to decrease exposures to clients that are under sanctions. So firms are, we're supposed to be practicing for what you call the known unknowns. We don't know exactly what they're going to be, but we need kind of a broad enough scope of things that we should be practicing for, so that if some other iteration, we've at least got a general way that we can attack it, so we're not solving it from scratch. Every time the situation has a unique nuance to it.
Yeah, because 6 months ago, nobody could have anticipated an invasion of a country, and suddenly the world is in chaos. So now let me go through some of these risks with both you and Ken, and I want to make sure our audience and I really understand them. You mentioned earlier on capital risk. Can you define capital risk for us?
So capital risk are things that could impact the capital, the equity base of the bank. So some of the things that have the largest ability to do that are things like credit risk, which is the failure of a bank's counterparties to honor their obligations; market risk, which are potential losses as a result of market conditions that could impact the value of our assets and liabilities and eat into capital. Then there are operational risks, which are failures of processes and systems that could, again, impact capital because there's a cost to the firm of fixing it or of that event. Model risk, which is, the one I run, misusing or poorly designed models. which again, if models are used incorrectly, we have a bad valuation on an asset. It impacts our capital because we have less capital than we thought. And, then there are the ancillary risks, which may not directly impact capital, like reputational risk, conduct risk, and legal risk. But as a result of a reputational, conduct, or legal event, we could wind up with a hit to capital because, as example, legal risk typically results in fines if you don't comply with regulatory requirements. A reputational event like Jerome Kerviel, who took on about 50 billion euros of unapproved positions, which resulted in a 5 billion euro loss for the bank he was at, results in a capital impact. So even things that don't directly look like capital can have a capital impact in how they play out.
I remember, again, going back a lot of years, when I was managing a firm, we were very big in the arbitrage business. And it was a very safe business for us. We had made money in 15 straight years, adequate rate of return, not a great rate of return, but adequate. And all of a sudden in 1987, October, as I recall, the market broke. Every arbitrage deal we were in broke. So all the shorts went up, the longs went down, and suddenly capital became a real risk. It was interesting how in 1 minute your life could change.
Yeah, I remember I was actually sitting on the trading desk for a little bit. I was being seconded there during the long-term capital management crisis, and everybody on the street had the same directional bets.
Absolutely.
And watching the correlations break, watching assets that were always trading in the ballpark of 102 go down to 90 in one day, it scared me, and it made me decide not to become a trader.
Yeah, we used to define arbitrage as collecting nickels in front of a steamroller, which is probably the truth. Let's talk about liquidity risk, the ability to maintain your funding. Can you talk about that?
Yeah, so banks typically, we don't keep an infinite store of cash on hand or enough cash that would meet all of our obligations over the entire time, a time period that they could be coming due. So the goal of a bank is to make sure that we have enough liquidity, enough cash available to us to meet those obligations on a short-term basis. So, and some of these capital events can impact liquidity because if you're in a credit crisis, as an example, and you have to sell assets cheaply and you're getting less than you thought you would before, you're effectively going to wind up with less cash than you thought, and you're using that to pay off something else, and it winds up being this almost steamroller, this self-fulfilling prophecy, and a number of banks go under because of these events that impact liquidity. So, when you're financing an asset, you assume you're going to have a spread once you paid off your financing. That goes away. That's a significant liquidity impact. And, that was a major cause of the financial crisis, as an example. So many of these companies that we were looking at felt that they had more than enough capital. Capital was the start of the problem, but it was liquidity and the faith in those banks that, if people would have, I heard from many of my friends who are working at institutions which didn't do as well, and even more, you wait a while, the assets are going to come back in value. Nobody's going to wait and give you the liquidity if they don't feel that the assets are there today. And so, again, just like many of these things can impact capital, they also have a follow-on effect on liquidity because it's not effective or efficient for banks to keep enough liquidity to meet all their obligations that they're going to have in the future.
Lisa, let me ask you a question about liquidity and the way it's monitored. I know in Basel III, we had the introduction of the liquidity coverage ratio and the non-stable funding ratio. What are your thoughts on how effective those are as measures of what's really going on?
So this is not the area where I'm the most expert, but from my understanding, first of all, I think that they're good frameworks. But again, to the extent that an institution loses its reputation, if it's thought of as an institution that isn't going to be a good quality institution over time, it could still wind up in a liquidity crisis if people think that these tools to manage liquidity, again, they don't provide you with the ability to look at your liquidity from an infinite perspective. So it helps you manage liquidity over a short and medium term. That's what they're designed to do. So if there's an absolute loss of faith in the company, liquidity could still dry up. And at that point, the view on capital becomes more important because you're in a liquidation scenario and the goal is not to blow up the market. So again, I think they're very useful tools for looking at a company's ability to manage short and medium term liquidity issues. But that's what they're designed to do.
I remember very well in the 2008-2009 crisis, a friend of mine who was the treasurer of a pretty major banking firm was at a major meeting with the executive committee one day. And the committee said, this will all come back. And the treasurer said, I'm sure you're right, it's going to come back. But in the interim, I'm losing tens of millions of dollars every day. And in another 3 weeks, we're going to be bankrupt. And they were.
So, yeah. A lot of it comes down to confidence in people's willingness to keep funding an institution, people's confidence in their ability to adequately value their assets, which again, we saw in the crisis. And, these assets may come back, but you have to make sure you have enough liquidity to see it come back over enough of a horizon to see it come back.
And in the long run, those around you will protect their own assets and not worry about yours. So when a crisis comes, you're going to have no friends. No friends.
Yep.
Can we talk about operational risk? Just the ability to function.
So operational risk is a very, very interesting one because people think of it as, oh, a computer breaks down or something goes wrong and it's easy to fix. I'll give you an example of an operational event that actually took down a firm. So there was a company called Knight Securities, and they went live with a computer system. And I don't know all the details, but it was using data that wasn't market data to trade assets. And it was using prices that were through the market. So people were hitting their bids on Apple stock, on IBM stock, whatever it was that they were trading, and the prices were so inflated that by the time they figured out that this error had occurred and shut it down and tried to cancel the trades in the market, some counterparties weren't willing to cancel, and they lost 3/4 of their capital base. 3/4 of their capital base in minutes because of an operational event. So you have to really know your controls really well. You have to have your checklist for when systems go live. You know what I'm saying? You have to follow them very well because those things which seem like small potatoes can be very big for a firm.
And would you consider that operational risk? And maybe we can conflate it with technology risk.
So typically at most firms, technology is a subset of operational risk, but somebody could also argue that it's effectively a conduct risk because this is something that an individual did by not following the operational protocols, which I'm sure existed there, that resulted in, an issue like this. So it's sometimes very hard. And by the way, sometimes when a risk event occurs and we have to analyze it here, it's very hard to draw the lines as distinctly as the risk frameworks of banks define them. Because a conduct event could result in an operational risk event. An operational risk event could wind up landing a firm in legal trouble, which is legal risk. You see what I'm saying? Something like an Archegos, which is, arguably also running across multiple of those stripes. Similarly, you know what I'm saying? The lines don't wind up being as definitively drawn as people would like them to be.
Is credit risk among the premier risks that you worry about?
So, yeah, the CRO is very concerned about credit risk. So credit risk can occur through multiple channels. So we have retail products, which is risk that we have to the individual consumers. We have wholesale credit risk, which are loans to large institutions. And then we have counterparty risk, which is a form of credit risk as well, because we provide financing of other counterparties' assets. And even if we think, we're safe in terms of the quality of the asset, what happens if the counterparty goes under? What is the implication to getting the asset back? Let's say that occurs at the same time as there's a market dislocation event. You know what I'm saying? So there are many different ways that you can get impacted as a firm by the credit situation in the market.
Are most banks syndicating lots of their risks, credit risks? And are they syndicating as rapidly as they can?
So it depends, because banks have an equity base, right? And they want to invest in credit because you earn a spread on it. So to the extent that we wind up taking on, more risk than we have the capital to support, yes, we would syndicate. There are certain businesses, for example, that a bank like a retail bank will keep on their balance sheet, like loans to customers, because you want to keep those loans. They're customers that you know very well. You have confidence in their credit profile. And then there's some other aspects like investment banking businesses where, yes, we do financing. We'll provide bridge financing until, an IPO can occur. So that's not something that an institution like an investment bank would want to keep on your balance sheet long term. So you wait for the other event to occur and, spread the risk to the markets. So that's two different ways that credit risk is entered into: longer term with core customers, and from an investment banking and underwriting perspective, some risks are inherently designed to be shared with the market.
Interesting, Larry, when you look at the risks that banks take as measured by the risk-weighted assets, which is the denominator of their capital ratio, the overall objective function of banks is to maximize their capital ratio, which is their equity capital divided by the risk-weighted assets. If you look at the risk-weighted assets of the largest banks in the country, it's overwhelmingly credit risk. After credit risk, even at a place like Goldman or Morgan Stanley, where they do a lot of trading, it's operational risk, which is the largest risk, and market risk comes in third. So the bulk of the risk being taken at financial institutions is credit risk, either in the form of direct lending risk or counterparty risk, either on trading or on derivatives exposure.
You think
Absolutely.
in general has lowered the risks in the system, not for any individual bank, or are banks prone to taking more risk because they know they're going to syndicate the loans?
That's a good question. Having been through the financial crisis, where many of these risks were syndicated, I think that you're right. I think it did give us somewhat of a false sense of comfort that, this won't impact us because we are securitizing, we are underwriting, you know what I'm saying? We are selling assets. We're just a facilitator in the bulk of the risk that we have, and we've only kept a small portion on our balance sheet. I think it did provide some comfort, but I think after the crisis, I think people realized that there are systemic risks that can occur in the market that can still impact you, and not to be complacent about that. And I think one of the good things that the federal government and most governments did was require banks to undergo stress testing processes to understand how systemic risks in the system can impact you as a firm. Because you may not have a large exposure, for example, to mortgages, but you may be financing somebody, you know what I'm saying, who they themselves have a large exposure to mortgages, and what's the implication if they go under? And what's the systemic risk associated with that? So I think there were a few things that were designed that help banks understand their vulnerabilities to broader market conditions, broader market changes, and how we as a firm should be managing those vulnerabilities. Should we be doing things like taking less risk in one sector than we're taking now? should we be raising more capital because we don't have enough capital to support the risks we have now? Do we have too much capital because under stress, we're operating in a very, benign way? We don't have significant loss, we have a lot more capital than our risk implies. What should we be doing with that capital? How can we improve, as Ken was suggesting, our return profile relative to the capital that we have?
You mentioned the word stress. What's your life like when it is a period of stress? I imagine right now it's a period of stress because of what's going on overseas. And domestically, interest rates are rising, an invasion in Ukraine, inflation at 8.5%, problems in the wheat market. What's your life like when all this is going on?
So the beauty of being in model risk is it's much less stressful because it's the people who are managing the other risk stripes who they have to evaluate the changes in the models, and then they come to us, and then we'll typically have some time to revalidate the impact of the current stress on the models that we use. However, when I was in capital, running capital and leverage management for the firm, and COVID struck, back then I was running capital strategically, not the full function, understanding what the implications of this event could be to our capital position meant understanding what was going to happen to the risk-weighted assets in our credit book, in our market book. Do we have enough capital to support the various scenarios that we're looking at? And we were going on and on trying to understand what the implications could be, where we would be most sensitive relative to things that could happen in the market, and, pulling back on capital from certain businesses, which would cause them to have to, decrease exposures. So, yes, if I would be in capital right now, given everything that's happening with Russia, and I'd be much more stressed than I am on the model side, which isn't as dynamically moving relative to the movements in the market. But yes, there have been many late nights, I know, because I've spoke with the CRO dealing with Russia and the implications of everything that's happening. It requires a lot of monitoring and a lot of scenario management to understand what's going to happen to the firm.
And just for our audience, CRO, Chief Risk Officer, so everybody.
Thank you.
I want to move to one more risk that you mentioned earlier on, Lisa, and that's reputational risk. To me, that's gained greater prominence today than it ever has before, as firms are subject to all this pressure from shareholders, from clients, from employees on the reputation of the firm. How do you feel it in what you do?
So I feel it quite acutely. I felt it probably more when I was in the capital function than in the models function. But the way I look at it is that you could have two firms that are making the same amount, same general return, right? And there's a discrepancy between how the two firms are trading, and they're in the same businesses. The reason why that discrepancy could occur is because the market has faith in one business's ability to consistently generate those firms, not have operational risk events, able to be the premier place to work so people want to work there, a place where people want to do business with, and the other less so. So again, you can have the exact same return profile in two different institutions for some period of time, but if the market isn't confident that one can sustain it and the other one can't, it can have a huge impact in the share price. It can have a huge impact in who wants to do business with you, the type of clients that you can retain. If people have a perception that you're going to do something to them from a client perspective, they're not going to want to do business with you, and the reputation will get out there in the street, and your market share in a product could go down. That's another place that reputation could impact the firm. If you don't stand behind your products.
This isn't in banking, but I was thinking of this problem with regard to Disney. I mean, Disney had a problem when they initiated this gay rights law in Florida, where the employees walked out and protested that Disney didn't respond properly. And then when they responded differently, the governor said, we're going to change the your ability to govern your park in Disney World. And you look at these companies and you say, how do you act? How do you preserve your reputation in the face of this onslaught from all sides? No matter what you do, it's wrong.
Well, that's why. So we like at firms like ours, they have committees of people who are responsible for the oversight of our reputation, for the position the firm wants to take in matters like this, where you have to take a position. This is the position we're going to take, you know, and you know, that's something that Ken was very involved with, is the U.S. Chief Risk Officer here, and he could probably weigh in on a little bit more. But, you know, decisions are made at the top of the house on what's the position, what's the likely market perception as a result of the position of the firm, you know, and are we prepared to deal with that?
I would say that sometimes there are transactions that could potentially make you a lot of money, but then you look at the potential reputational risk you would take. I remember seeing at Morgan Stanley a transaction where they wanted to bring in many tons of the Athabasca tar sands by train through New Jersey to Bayway to refine. And I thought, this is not a deal that I want to be involved in. Early on with crypto, and to some extent still with crypto assets, we'll see new product issues come up. And sometimes it's not a matter of saying no, it's a matter of elevating it to the right level of concern. When an issue involving the financing of a crypto exchange offshore came up, my approach was, we have to make sure that senior management knows, very senior management, like the CEO and the chief risk officer, know that this is being considered by the business. So a key part of it is just making sure that the right people are informed, so that when the decision is made, there's been a risk reward judgment that's been made with respect to it.
Well, as long as you've mentioned crypto, does crypto get to your desk, Lisa?
So I can't really talk about that right now,
Okay.
but crypto is an emerging asset that, you know, obviously the firm is looking at. And then
Every
to the
firm
extent that
is.
there would be models, yeah, that is the kind of thing that we would be looking at and trying to understand if the way we manage that risk was designed correctly. There is one more risk I want to mention before we, you know, I know we're getting close to the end. Climate risk is an emerging risk, because there are potential implications, obviously, as the firm cycles to green assets. What's going to be the implication of the financing, that the value of the loan that we've made to something that's brown if people don't want to be invested there? And then additionally, what's the implication, for example, of, you know, the credit risk we have on property values near shorelines if, you know, oceans are becoming elevated? So understanding how to manage climate risk, you know, how we want to be financing customers with climate exposure in the market is becoming much bigger, and is something that a lot of firms are taking more and more seriously, and regulators are starting to require disclosures on. So I think you're going to see more people talking about that over the coming years, even though we're not explicitly seeing an economic risk impact yet. We're starting to see things through, again, frequency of weather events and things like that, that we're still kind of looking at through credit or other insured risks on homes and things like that, that are elevating and that are going to become, it's becoming more and more common to see firms talk about how they manage climate risk.
And do you model that? Are you taking the information now and creating models?
Yes, so we actually are. I think there's some of the predictive power of a model like that, which doesn't have any historical event to base the future outcomes off of, is probably weaker than a lot of the credit and other models that we have. But again, it's an area that we're monitoring. We're taking the information that we have today. We're taking the predictions by, leading scientists in terms of what the implications, their future implications based on their predictive models, what that means to our exposures, again, where we have property exposure, things like that, so we can understand what could be the potential impact for the firm. So we look at things kind of through different lenses right now. But again, from a precision perspective, I think these models are probably the least precise of a portfolio of models that we look at the firm right now.
I think in a broader sense, Larry, we're still trying to get our arms around the metrics used for ESG type risks. ESG is getting a lot of airplay. There's a lot of discussion, but there's no set of standards. There's no set of disclosure standards that exists right now. And I think banks are all wrestling with how that can be discussed in such a way that you can compare one bank to another. The capital stuff happened 25, 30 years ago to level the playing field, to make sure that everybody is disclosing something similar so we can understand the risks that we take. With stress testing, it was standardized after the financial crisis. There was no standard for stress tests before 2008. And then with Dodd-Frank came the rule that all banks have to go through certain standardized stress tests. I think ESG broadly and environmental risk in particular will have, the reporting thereon will have to be evolve in such a way that we can compare firm A's climate risk, for example, to another firm's climate risk. And I think we have to think about that both in terms of direct risk, meaning you get your feet wet, and indirect risk, meaning your suppliers get their feet wet. You can't, your supply chain, for example, is interrupted.
Yeah, and just for those who don't, it's environmental, social, and governance is what ESG stands for. But yeah, so again, regulators are starting to put out preliminary views of what that disclosure that Ken's noting will look like. But I agree, it's going to evolve significantly over the coming years before we land on something that I think hits all the right notes.
How about competitive risk, both in terms of technology and the ability to facilitate your own business, and technology based on the services you can provide to clients? Who's monitoring all that to make sure, I'm using Barclays now, but it could be any bank, is maintaining its position as a good competitor? Who do they look to? Do they look to JP Morgan because they're on the cutting edge of all this stuff, or not?
So I think generically, I think there's typically a strategy function at banks which look at what the competitive landscape looks like, and the products that our competitors in, how they offer the products, and where we are relative to those competitors. I think it winds up creating income risk if our product has more friction than a competitor's product, by virtue of the fact that, you have a bank account with Bank X, right? And they have a very inconvenient way to get your cash from them. Odds are you're going to lose your client base, right? And you'll be subject to an acquisition, or you'll have to shut down. So understanding where the market is heading is more of a strategic objective of the institution. But I agree with you. It is a big risk, a competitive risk to the firm. And I think it is looked at operationally through our operational risk stripe in terms of where we are relative to peers and what the risk is of loss of customers, loss of clients as a result of the fact of our framework is our product has more friction than a competitor does. So I think it is a big concern of all institutions that, we make things as convenient and friendly for our customers, because we're not going to have them if we're a pain point for them.
I have a friend who's also been a guest in my class on many occasions, and he's in the consulting business, and he consults for a number of large financial institutions. And one of the financial institutions he consults with hires him to periodically come in to do an emergency trial. So he might come in. I'm sure he's never done this because nobody would have imagined it. But he could walk in one day and say, Russia has just invaded Ukraine. You've got 16 branches in Moscow or God knows what. And what are you going to do? Who's in charge? What's the information flow? What are the controls? And they've got to come up with a response within some number of hours. Does that get done at most banks?
Yes, most banks do run crisis scenarios and they have crisis playbooks. So again, each crisis will be a little bit different than the last one, but you call out your crisis playbook, you look at what are the critical risks that we would need to manage given the type of crisis that it is. And again, in this case, it was sanctions, it was exposure to Russian ruble, it was client exposure, all those different things. And you look at, how would we address it? And generally the playbooks aren't going to be perfect, as we talked about, because not every crisis is going to be the same as what you planned for, but at least it gives you a starting point. And it means you're not going in completely blind, and you're less likely to make mistakes in how you manage the crisis because you've got something that you can call to that gives you an approach. You're not going from scratch when you're in the midst of the crisis, which I think is very important.
The one he did in my class was, I'm sorry, Ken, I apologize.
I think a really good example of that is something called the contingency funding plan. All banks are required to have very detailed contingency funding plans that are the playbook. They are literally the playbook that Lisa had just mentioned. When things start to go south, you are expected to have ways of raising funds or liquidating assets. And it's one of the things that regulators focus on. And banks all over the world are required to have it. There's an extensive literature that has evolved as a result.
I'm very glad.
Yeah, they have similar things on the capital side as well, not just on the liquidity side. You have a management actions list of actions that you could take to preserve capital under stress. Banks are pretty well prepared now. I'm not going to say we're never going to have anything happen like happened during the financial crisis, but I think something much worse has to happen than happened then to take banks to a position where we're going to have the same level of waves of default, given the amount of capital and preparation that banks have now.
A friend of mine used to say, they get you a new way every time.
But this way will have to be a little bit worse than the last, hopefully much worse than the last way.
No question, we've prepared much better. The crisis that my friend employed last time when he was in my class was the CEO has just had a stroke. We don't know how serious it is. What are you doing?
So most organizations have succession plans, and they would invoke the succession plans, get the people, I'm assuming get the people who are behind the CEO to make sure whoever is the successor is fully aware. Some institutions have succession plans where they really have a second in line fully planned out. Barclays had, our CEO, our current CEO was a clearly defined successor to our prior CEO, so it made the process, I think, smooth. Other institutions may not have somebody who they feel is capable of being in the CEO spot, so that individual or a combination of individuals will serve in that role on a temporary basis until a search can be conducted for a successor. But you're right, it's very important to understand what do you do, either permanently or temporarily. Again, another crisis playbook if something happens to the CEO.
Let me ask you this. If you weren't as sophisticated as Lisa Farkovits or Ken Abbott, how would you satisfy yourself that your local banking institution is a safe place for your money?
Well, from a local banking institution perspective, I'm very pleased to say we have something called the Federal Deposit Insurance Corporation. So a decent chunk of your deposits are insured, which gives me a great deal of comfort and makes me not look as closely, you know what I'm saying, within deposit limits.
Is it still 250,000?
Yeah, I think it's still 250,000 per individual. I think we should look it up, but and they have similar things for wealth managers, through the SIPC. So they've got, these things that there is government support. So that way, banks can get on a more level playing field, certainly at the retail level, and bring customers in at that level. But what I typically would look at is independent rating agencies' rating of the banks. If you have more assets than those minima, Moody's, Standard & Poor's, Fitch, they rate all the banks. If you want a really high quality bank, go that way. If you want to make a lot of interest on your savings account, you won't get that from the highest quality bank. That's a decision, that's a risk that you're going to take at an individual level. And you'll probably want to look for a more lower rated deposit institution if you want a higher interest rate on your deposit accounts.
But it's important to note that post-crisis regulation has forced increased capitalization across the entire spectrum.
Correct.
So it's not just the big banks that have had to increase their capital 50-odd% in some cases. Small banks too, and they're still subject to a great deal of scrutiny, because most small banks are either going to be Fed regulated or state regulated, and if they're state regulated, their primary regulator is going to be the FDIC. So there are people minding the store across the board.
Gwen, I see you in front of me, and I know you have some questions from our audience.
Yes, as usual, there are quite a few questions. What kind of procedures are in place now to handle fraud in the dot-com era?
So fraud, so what typically happens is, like in credit card portfolios, which is where we see probably the bulk of the fraud in most institutions, retail-oriented fraud, there are models that look at customer behavior, that look at irregular customer behavior, and try to create predictive scores that try to help the firm understand when fraud's occurring. So yes, it's so much easier to access and get credit right now, but being able to understand when a customer profile that is indicative of fraud is the best way that firms can mitigate that. So we've got histories of researching fraud, and those histories have been used in building the models that we have today, and they're good at allowing us to predict or rank order outcomes and say these are the most likely fraudulent outcomes. And that's how most firms monitor fraud right now. It's very technical, certainly on the retail side, because there's so many customers. Not every single account, not every single transaction can be looked through by a human. So that was a good question.
In the context of risk management, would you consider this a type of risk that is really very well managed at this point?
I think it is very decently managed. I think the one thing, and I think you said this, Larry, you never know what they're going to come up with next, like ways to take down institutions. You never know what they're going to come. So there's literally teams who monitor and look at the different types of events and different types of things that we see. And fraud models are actually some of the most frequently updated models in the firm, because you got to stay one step ahead.
It's a little bit of whack-a-mole. Because
it's very much that
out there, they're doing their homework. Every time a security improvement is made in software, they're trying to figure out a way to get around it.
Or somebody once said to me, while you're sleeping at night, they're awake thinking.
Yeah.
Now imagine how productive these people would be in, like, good businesses if they spend as much time thinking about ways they could serve customers of the market instead of thinking about ways to steal from other businesses. I've often wondered that, by the way. It takes a lot of effort to do sophisticated fraud.
All right, here's a question for Ken. For Baruch undergrad students who would like to work in the area of risk management, can you give your advice on the best majors, and are there any particular kinds of courses or disciplines that they should be looking at?
I think that having a strong background in finance or accounting certainly can help initially, but big banks hire English majors and music majors as well. I think the important thing isn't necessarily the major, but it's the courses that you take in particular. If I came across a music major who had 3 semesters of calculus, 2 semesters of statistics, that person would be perhaps just as well qualified I'm actually thinking of somebody I know with a doctorate in music who runs IT risk at Bank of America right now. As long as people have the requisite courses and the requisite background in certain disciplines, you're looking for a good athlete that you can train in whatever sport you want them to participate in at a bank. Lisa, what are your thoughts on that?
So the way I marketed myself initially, because I was physical chemistry who had not taken any of the courses you recommend, and I spent a lot of time with friends figuring out how to do that, is same math, different word problem. So I had to convince people that I had, just as you noted, the core skills to be able to do what was expected of me when I got here. And it worked. I've been on Wall Street for about 25 years, so I did a good sales job back then.
But I must tell you, Gwen, I have a grandson that's about to start college, and he's going to be in a liberal arts kind of a program. And I said to him, and he was worried about what's he going to do when he gets out. I said, you have 4 years, stop worrying about it. But one of the things you should think about is how to learn, because whatever you learn now, 4 years from now, it's going to be obsolete. So you got to learn, and you have to learn something Ken said before, to be curious. You have to be willing to pursue things, to understand that things change. And the greater your curiosity, the greater your learning ability.
All right, Lisa.
Yeah, I agree with that as well. Yeah, very important.
Lisa, here's a question for you. In your position, you obviously need a lot of technical skills. As you gained experience and advanced at Barclays, how important were managerial and people skills? Did you learn those on the job? Were there any formal trainings at Barclays? Were there mentorship or sponsorship opportunities that you benefited from?
So I would say I was a horrible manager when I first started managing people on Wall Street. Until that point, I was focused on doing and action-oriented work. I wasn't focused on the way I should have been, larger scale outcomes, longer term impacts, and the human implications of the things I did or said. I think my first role at Morgan Stanley, I was also a very mediocre manager. I got a little bit better. I was good at giving guidance on, the activities that people needed to do, but I wasn't good at giving guidance on how people should get ahead. You know what I'm saying, on the more personal aspects of management. And it was when I did not make managing director for the second time at Morgan Stanley, the firm was kind enough to give me a coach. And the coach said, look, you're very intelligent. Stop taking notes on the facts in the meeting. I'm sure you never look back on your notes. Start taking notes on how people communicate, on how people run the room, on how people, you know what I'm saying, responded to you when you needed good guidance. And I took that advice very seriously. And I started really listening, not to what they were talking about just from a subject matter perspective, but the more EQ aspects of the interactions. And so, and I looked at how people would respond. So even to this day, I'll sometimes have a meeting with somebody and it doesn't go the way that I want. So I spend time thinking about, I want this person to be effective. I don't want them to be thinking about this meeting long term. What can I do to get them comfortable that I still have faith in them, or I'll send an email saying, I'm so grateful for the hard work you do. You know what I'm saying? So I'll send emails that are specific. It's a mentality shift. Being able to manage people means you have to have the interests and the mindset of such a wide range of personalities at heart. And it's not something that you can, I think, learn in school. It takes a lot of observation and a lot of listening. So it's probably the hardest question that I've been asked all day. It's a tough one.
Well, thank you very much, Lisa. We have a last question here for Larry. Following this discussion that you had with Ken and Lisa, do you end the session feeling that you have more confidence in the banking system's ability to deal with whatever is going to challenge it next?
I absolutely do, because I see people like Ken and Lisa in these positions of power, and the emphasis on risk control and the quality of the people that are now being put in these jobs. I look back at Neuberger Berman, at the people in my old firm that are being put in these jobs. I absolutely have faith in the system. And I think what we went through in 2008, 2009 is not going to be repeated. We'll have other events, but not to the extent that 2008 and 2009 occurred. So I thank you both.
I thank you all. And I want to tell our audience that our next webinar is on big data. Who uses it, who provides it, what risk does it create? Larry's guest will be Roger Freeman, who is co-head of data science at Neuberger Berman, and our own professor of economics, Professor Sebastiano Manzan. That's for next month. Thank you, Larry. Thank you, Ken. Thank you, Lisa, for a really interesting discussion.
Great.
Take
Thank
care,
you for
everybody.
having us.
Thank you, everybody.